Okay, ladies and gentlemen, so hopefully you had a chance to just go through everything a few times. It's a lot of information there, so you might want to spend some time going through definitely worth doing, okay? Whether you use Google or whether you use the interest, I was going to say the interest rates, but the Federal Reserve website about the Fed, and you can read through, and there's lots of stuff there. Structure of the Federal Reserve System, and read through it. The board, how it works, all of that. The Fed Explained, great section. You can read all of these and go through them, and you should be able to understand them a little bit better once you've gone through. And I've explained some of the little nuances about how the Fed works, and you can see that it has changed a lot since 2008. But the most, don't worry too much about the technical aspects of how the Federal Reserve influences interest rates. If you're still a little bit confused on that, don't worry about it too much. It's not that important. Most important thing to understand is what we talked about before, like the makeup of the Fed, in terms of the Federal Reserve System, and then you've got the FOMC, you've got the Board of Governors here, Federal Reserve Board of Governors, 7, and then the 12 reserve banks, and all the stuff we've already talked about, and then 4 members from the reserve banks, plus the board, plus the New York Fed president is the 5th person. 5 plus 7 is the 12 that sit on the FOMC, okay, and they make policy decisions when it comes to interest rates and the job that they're trying to do through these 12 reserve banks, which we already discussed. I won't bother bringing up that picture, the picture of all the banks. In fact, I will. I like to do things properly, so let's just bring that up. Structure of the Federal Reserve System. Right, through these 12 reserve banks, and they'll be implementing or pressurizing the system to follow the target rates that they set during their meetings. So that is the 12 reserve banks. And why do they do that? To influence commercial and private banks, basically all the banks that help the economy function in terms of the circular flow of income, right? Because they will have an interest rate that they charge to households. We've drawn this a million times now. Businesses, and so on and so forth, and it helps that circular flow of income, okay? We've already discussed how this interest rate impacts C plus I plus G plus X minus and the price level, right? So we went through all of this in part 1. That's really just the most important stuff to understand, okay, is this. Cannot stress this enough. If you understand that, you're good to go, okay? You understand it probably better than most people. Just understand that the FOMC, via the reserve banks, is trying to influence that interest rate, okay? The tools it has open to them, and once it sets the rate, because don't forget, a lot of people just think they set an interest rate and everyone has to listen. They don't, okay? It's the federal funds rate. We talked about it already. Okay, and that sounds like a fancy term. It isn't. It's just the rate at which banks lend to each other using their reserves held at the Federal Reserve banks. Okay, hence the federal funds rate. Okay, now that rate is obviously the banks will be borrowing from each other at, and that will influence the interest rates that they charge you because you are here, right, in this circular flow of income. You're a consumer, right? That's you. C. We know this already. You're an expenditure. You're going to be borrowing for cars, for mortgages, for a lot of items, short-term loans you might be taking out. So obviously the Fed will be trying to influence those rates. Okay, and if you understand that, that's pretty much you're good to go. And then the little thing we talked about, when interest rates go up, how do they influence GDP, employment and inflation? Interest rates go down. We won't cover this again. We covered it before. Just generally understand that this rate is this commercial rate that banks are charging. Okay, it's not the federal funds rate. The federal funds rate is what is kind of that base rate, I guess you could call it. Cost of borrowing for banks before they slap on their profit on top. Okay, but if that base rate goes up and down, if it costs more for the bank to borrow money, wherever they're borrowing it from, right? Whether that's they're borrowing from each other, whether they're borrowing in the open marketplace, whether they're borrowing in the federal funds market, if that rate starts to go up, it's going to push up the interest rates for everyone. Okay, that's very important to understand, and that will have a knock-on impact to GDP, employment, and inflation. And obviously, if GDP goes up, that's good, but not too fast. If GDP goes down, that's very bad. If employment goes up, that's great, but not too fast, as we said, because it can cause inflationary pressure, same as GDP going up too much. And inflation, we said already, we talked about it a lot, about why 2% is a healthy growth rate and we can't have too much inflation. And the final thing, just to kind of remember and summarize, and we're going to get into the statement in a second, and it is important I say all this because I need to make sure you're all on the right page. The way that the Federal Reserve influence that interest rate open to the economy, and also I'm just going to introduce one other thing I forgot to mention before about their open market operations, which has obviously just been kind of a new phenomenon since 2008, is using open market operations to influence longer term interest rates. And I'll talk about that in a second, partly because during 2008 interest rates went down to zero and the economy was still in trouble, so they needed to think of innovative ways to continue to provide liquidity to the market, or to help costs of borrowing come down to stimulate the economy. So we'll just want to mention, and kind of nice to do this with the summary, so they're obviously trying to influence interest rates in the broader economy, right? And they do that by obviously influencing the Fed funds rate, which is what you see that is set. They have other ways of pressuring banks. So we talked about the reserve requirement, but because there's so much abundant liquidity in the market nowadays, people's banks' reserves are so high, and it really wasn't an effective way anymore. Didn't make any sense. Who cares if you've got a 10% reserve requirement? There's so much money in the economy now, as we've seen with that chart I showed you about the Federal Reserve's balance sheet. They've pumped so much money into the economy, kind of became redundant to use changes in the reserve requirement. So they just put it to zero, basically, across the board. And that also helped maybe some institutions, commercial institutions, that struggled to meet the previous requirement, right? And that even helped to pump even more liquidity into the market, because now if you don't have a reserve requirement, you don't need to hold any money at the Fed. You can do stuff with that. You can lend that money out. You can use that to stimulate the economy. So don't really use that anymore, the reserve requirement. And because, like as we saw before, right, and hopefully you got that with the reserves now so high, it's not effective anymore using the open market operations to influence the federal funds rate. So they do it by introducing their own rate on deposits, right? The IORB, interest on reserve balances, which is a great way to influence the federal funds rate because it acts as a competitor. And because of arbitrage and obviously you can't have one rate cheaper than the other, otherwise people will be able to make money and then the rates would come together anyway. They're able to now influence that federal funds rate using the interest on. So this is their main tool still, okay? Setting of interest rates. You've got the discount rate as well. And the thing is, you can read about all of these, okay? I don't want you to just think I'm just telling you this for the sake of it. I'm just doing my job, basically. I'm making sure you know what you need to know. Go to monetary policy. Can you see policy tools? Monetary policy tools. And they've got them all there. open market operation, discount rate, reserve requirements, interest on reserve balances, and so on and so forth. Okay, they're still all there, and you can have a look at them for yourself. In fact, on the website, summarized quite nicely here everything I've been teaching in monetary policy about the FOMC. Actually, is there about the FOMC. Federal Reserve controls the three tools of monetary policy: open market operations, discount rate, and reserve requirements. We talked about that. Using the three tools, the Fed influences the demand for and supply of balances that depository institutions hold at Federal Reserve banks, right? Which is the federal funds rate. Okay, so that's obviously a major policy tool that they use. Now obviously they've started using this IORB because, as I said, there's abundant liquidity around. The thing is, all you need to really know, if you don't understand a lot of that, don't worry about it. Doesn't mean that you're gonna fail at trading. My guess is that most traders don't understand half the stuff I've been talking about, and that doesn't make them worse traders. So don't worry about it too much. The main thing you need to know is they're trying to influence interest rates out there in the economy to go up or to go down. They have a mechanism to do that. Can either do it via reserve requirements, but those are now at zero, so they don't really use that. Discount rate isn't really used so much because there's a stigma attached to banks for using that. You know, banks don't want to be seen to be borrowing from the Fed, so they don't really use that. So the main tools that they're using now are obviously the IORB to influence interest rates. But a new phenomenon, and I forgot to mention it last time, is they're now using the open market. So they stopped using open market operations in the way that they used to use it pre-2008. So before, they used to use it to influence the short-term Fed funds rate. The problem is, I don't know if you know this, but in 2008, right, and we're going to get to the statement in a second. Let me just see if I can find the history. So about the FOMC, if you go to let me see if I can just find it really quickly. So it's about the FOMC. No, I think it's about the Fed. Fed explained, and then I don't know which. I think it's one of these. I've seen a little graph. 3 key system entities, maybe. If you scroll through here, I think there it is. Yeah, there it is. Can you see the federal funds rate there over time? Okay. Can you see what happened in? It's very important. This. Can you see what happened in? Oh God, I don't want to get rid of what I've written. So if you could just see that there. Can you see that in 2008 during the housing crisis? It went down to zero. Rates went down to zero. Right, historically low rates. The problem was that rates went down to zero, and they did use obviously their open market operations to influence the federal funds rate in the way that I described in part 2. But once rates went down to zero, there's nothing else they can do. Right, that's it. It's like they're maxed out. But the economy was still doing poor, like not poorly, but obviously was still in trouble, and they needed more capital injection. Can't lower interest rates anymore. They're already maxed out. They've gone down to zero. There's no use using the open market operations because they've pushed it down, as you know, it's within target 0 to 0.25. You're at the target. 0 to 0.25%. Right. FFR. You're at the target. That's 0 to 0.25. Sorry, I don't know if you can read that. 0 to 0.25%. That's it. You can't lower it anymore, right? And it's not. You can't use the open market operations because the market is in that target range. So what they did is they expanded their balance sheet further, continue to use open market operations, but in a different way. They started to purchase longer term securities, okay, longer term bonds, and so treasuries, longer term treasuries and mortgage-backed securities, okay. And what they were trying to do, so the short end, so you know the curve, right? The interest rate curve. So typically how it is in a normal environment is it's obviously lower interest rates at the short end and then higher interest rates at the long end, obviously, because it's obviously more risk for a bank to lend you money for a longer period of time, so there will obviously be a higher interest rate. So let's say it might be, I'm just making this up, 5%, and here it's typically 2% or whatever to borrow for a shorter period of time. And then obviously you get the advantage as well of a fix, right? You get to fix, so there's more risk for the bank, so obviously they're going to charge you a higher rate to fix it for longer. And this is really an important influence on longer term purchases. Things like homes, houses will be determined by longer term interest rates, long term car purchases, and so on and so forth. Big influencer of C, consumption, right? C plus I. It always comes back to that, right? You know that by now. Massive influence on consumption expenditures, longer term interest rates. So this had gone to zero now, right? They maxed this out, the short end. They can't push it down any further. What's left for them to do? They can start pushing this down. Okay, so that's what they did. And I can't remember the longer term rates. I think they were around 6% in 2008. And what they did is they used this open market operations. Do you remember how I taught you in the second part? They used to use it to push the short end, the FFR, federal funds rate, down at the short end. It's already gone to zero. Nothing else left to do. How do you stimulate the economy? Reduce longer term interest rates. So they then use that. It's a new phenomenon post 2008. Okay, so it's very, a lot of textbooks and things and economics textbooks and a lot of stuff has not been updated because obviously this is a relatively new phenomenon, and it's become even more prevalent in 2020 with the COVID crisis. If we look at the balance sheet, let me see if I can find the balance sheet. I may have lost it now. Just give me one moment. There we go. See that? That was 2008, where they started to purchase longer term securities and obviously try to also pump some liquidity into the short end, but in terms of pumping up banks' reserves, but also purchasing simultaneously purchasing longer term securities. So you can see that here, something they just kept going through any issues that the economy may have had since 2008, particularly in 2020 with the COVID crisis, right? And they've just continued to pump liquidity into the economy. So they've started to use the open market operations in a different way to exert pressure on longer term rates, which isn't something they've typically done historically, but they started to do that there. But I think I've read something Bernanke said, I think it's because of Japan have done similar types of things effectively when they had deflationary issues and they went down to 0%, and so there's something that they obviously learned from that experience and tried to replicate that here and worked very effectively pushing the longer term rates down. I think they got it down as low as 3% at one stage, and they've continued to use that effectively to keep the longer term rates down. Okay, so that's another tool that they use. I think what they were doing is purchasing 80 billion in long-term treasuries and 40 billion in mortgage-backed securities for some time. Okay, so you may read about that. I'm mentioning this because it's a big tool of monetary policy that's become very, very important, especially in the last couple of years. You can see it here. Sorry to go over this again. But just when they were thinking about, they started to reverse a lot of that. They started to buy up treasuries again. Don't forget what effect that has, right? Buying up treasuries means that they're putting money into the accounts of all those commercial banks that sell it to them, right? So they're pumping liquidity into the economy. That's what it does. And it also has the effect of lowering the rates of longer term securities, because it makes them it drives the prices up, right, of those longer term securities. So essentially what that does is it drives the rates down of those longer term securities. And why? If you think about it, you can think about it from a valuation perspective. I talked about discounted cash flows, but I don't want to get into that right now. But there's another way of thinking about it, even if you just want to think about it logically, right? If there's all these long-term bonds in the market and they're being bought up, to buy them, people are willing to if someone sells them to you, they're willing to pay a yield of 6%, or give up 6%. Obviously, if they start being bought, people are going to be willing to give up a smaller yield, right? It stands to reason. People start buying all these bonds up, right? The person buying them is going to get less and less interest rate for those, because that means there's more demand for them. So interest rates do start to drop, if you want to think of it from that perspective. So really important to understand going forward. Okay, doesn't seem to want to delete. Sorry, I don't know what is going on here. Okay, just forget it. Yeah, really important to understand that there's these tools now at the Fed's disposal. It's no longer like before. They've introduced the open, or they've changed the way they use their open market operations. Okay, so they're now using their balance sheet a lot to purchase long-term securities, which you can see here, the balance sheet. You see, they've never really done that historically. They've obviously held some assets, but completely gone through the roof now in terms of their purchases. Okay, and that's not the same. A lot of people think it's printing money. It isn't. Okay, I guess you could argue it is if they don't reverse it, or they have no intention to reverse it. But according to the Fed, this is all potentially plans to be reversed. Okay, and we're seeing that this year. To be fair, you can see they already started to reverse to try and get back to a normal, and they're going to try and start again. The reason I'm mentioning this is because it will come up, right? If you start to read about FOMC and you want to really understand fundamentals, a lot of research reports you read or stuff you read on the internet, it will talk about this. And that's why I just wanted to explain to you what this is, so you understand it, that it is a tool that the Fed uses to pump liquidity into the economy, but the kind of underlying intention is to reverse it. Okay, now obviously to purchase this stuff, you could argue they print money, they create a reserve, right, a balance of money to go and obviously purchase it, but it isn't unlimited money that the government can use or this can use it. Intention is to reverse this back down to more normal levels, and what this does is it just provides temporary support to the economy. It's almost a way of it is the same as stimulating the economy using interest rates, but instead of short term, which have already got to zero, so what can you do? It's longer term, pushing those down and hoping that has a stimulating effect, which it does, of course, because as I said, longer term rates have that effect. So basically the reason I'm mentioning all of this is because I want you to know what tools the FOMC has at its disposal before we go any further. Really, really important. Okay, so one is the federal funds rate, and that is the classic famous FOMC has changed its interest rate, and that's what they're talking about. Okay, so federal funds rate. Number two is open market operations. I like to think of it as balance sheet. Okay, their balance sheet, so they can pump liquidity into the longer term part of the yield curve, or they can suck it out. Okay, so that is this balance sheet. Okay, so really important to understand when this goes up and people are talking about, hey, they're expanding their balance sheet. What that means is they're buying assets. Okay, they're buying longer term treasuries, and what that's doing is it's pushing the yields down in the longer end. And that's why it's very positive, because what happens when interest rates go down, remember what we already drew, it helps GDP, helps employment, and so on and so forth. And then the final thing just to remember is the mandate from Congress. Okay, really important. Dual mandate is employment. Inflation. Okay, and this isn't a mandate, but I like to put it there anyway, GDP, because they do look at it. Obviously, that's the ultimate goal, is economic growth. But they're doing that via using the tools here and by keeping employment at maximum employment and 2% inflation. Inflation. And there is just one other thing I forgot about the tools. Okay, it's communication. Okay, and this is really important, and that's the whole point of this section. Statement. And to a lesser extent, the minutes. Okay, communication is absolutely everything. This is a big thing for the Fed, because you've got to remember, okay, and this is really where it matters as a trader, is communication, understanding this. I would say this is really where you can add value to your trading, is understanding the communication, because the Fed, especially in the last 10 years, mistakes made in the past, maybe not communicating things properly, have got better and better, and they are trying to do a much better job, and they have doing a really good job of trying to communicate their intentions well in advance. Okay, and the way they will do that, okay, is they will always discuss things in terms of their dual mandate. Okay, so they'll give you their view on employment, and we've seen that, right? Show you that. Monetary policy, about the FOMC, where's it gone? Meeting calendars, a statement on long run goals and monetary policy strategy statement. Okay. The FOMC is committed to fulfilling its statutory mandate from Congress. Okay, and that is, remember that? Congress, dual mandate, okay. Of promoting maximum employment and stable prices. And I know I repeat things, maximum employment, stable prices, but it's important you understand. Okay. The committee seeks to explain its monetary policy decisions to the public as clearly as possible. Okay, and might as well just read this last bit. Clarity facilitates well-informed decision makings by households and businesses, reduces economic and financial uncertainty, and increases the effectiveness of monetary policy, etc., etc. So employment, inflation, long-term interest rates fluctuate over time in response to economic and financial disturbances. Monetary policy plays an important role in stabilizing the economy. Okay, the circular flow of income, right? Trying to stabilize that basically, because there will be disturbances to that due to external factors or structural changes or whatever the reason is. They will step in, obviously using these tools. Okay, these tools here to influence what? Employment, inflation, and ultimately economic growth. Okay, now the reason communication is so important, and we're going to look at this, we're going to look at the statement, right? And this is really what this whole 3-4 hours, I don't know how long we've been talking about the Fed, is leading up to. Okay, and it was so important you understood this. If you really want to understand how I and other institutional traders look at fundamentals, completely different to any of the nonsense that you've probably seen on YouTube or here, or let's be honest, on social media. People who haven't got a clue, you can see. People aren't willing to do this work that I've just showed you for 4 hours. No one's going to look at that. If you really want to know how professional traders do it, anyone can do it, okay, and you can do it. And if you spent the time watching the videos, you're in a very good place to do this. Is you just need to think as if you are the FOMC. That's how I do it. For me, I'm thinking, okay, I'm an FOMC member. What is my mandate? Okay, I need to achieve maximum employment. I need to achieve stable prices, 2%, and I need to obviously maintain economic growth, even though that's not in their mandate. Ultimately, that is what they're there for. How can I do that? Okay, I've got these tools in front of me. Either I can pump money. Basically, I either need to be aggressive with monetary policy, as in, make rates go up, or try and influence the rate to go up using Fed funds rate or my balance sheet, i.e. via open market operations or the federal funds rate. Or alternatively, I need to do the opposite, right? So what did I say? We either can make rates go up, or otherwise I need to try and stimulate the economy by lowering rates. Again, using the tools at my disposal. Okay, but there is another factor you need to consider, and that is using the tools at my disposal. So essentially, what am I going to be watching? I'm going to be watching the things that Congress wants me to watch: employment and inflation. So when I communicate to the market what I'm thinking, I'm always going to be talking about what? My job. Employment. I need to make sure there's maximum employment, and I need to make sure inflation or prices are stable, right? Now, what you can then do is flip it around. Now, if you're thinking, because what is it? Think about what we're here for. We want to try and second guess what the Fed is going to do next, right? Are they going to put rates up? Are they going to put rates down? Are they going to put the brakes on the circular flow of income, GDP, or are they going to put the accelerator on? Brakes, interest rates up, interest rates down, accelerator. Okay. Now, the thing is, we don't know unless the Fed explicitly tells us at the next meeting we're going to raise rates. But they can't say that because they don't know. They need to take a vote, right? And they need to discuss it. We're going to talk about how that works in a second. And then we may not know for several months whether it's going to happen or not. But we need to know what the feeling is within the committee. This committee of 12 members. What's the feeling? How are they feeling? Are they likely to raise rates in the future? Are they likely to reduce rates? Because this is one thing we haven't talked about yet. Okay, very, very important. Expectations are everything. Okay, really, really, probably the most important part of the last 4 hours. Understanding expectations of monetary policy, stroke interest rates. Okay, because if you notice, the market will react well ahead of any change. So if the Fed, decides that it wants to start raising interest rates, the Fed will try and hint that it's at least on their mind, and it's up to a good trader to be able to read what is on the minds of the FOMC. Now, unless the FOMC communicate that, we're not mind readers. I haven't got a crystal ball. I don't know what's in the FOMC members, right? Remember the seven governors and the four presidents of the Federal Reserve banks. I don't know what's in their mind. They need to communicate it to me. They're not just gonna, but the way that they communicate it is they're going to basically tell me, this is what I'm thinking about employment right now. Okay, Congress is, so this is where I'm flipping back and forward between thinking as if I'm an FOMC member and thinking as if I'm an institutional trader. If you are an FOMC member, right, and you need to decide on interest rates, what's going to influence that decision? It's going to be these things. Employment and inflation, right? Why? Because that's your job. What is your job? To create maximum employment and to keep prices stable. If employment is not going towards maximum employment, you're going to have to take action. Would you agree? What's your job? If inflation isn't at 2% and it starts to get out of control, you're going to have to do something. Why? Because that's your job. and I don't mean this in a rude way, but I literally don't think people understand this, so I'm going to say this. Congress has not tasked the FOMC to go and, I don't know, change something completely irrelevant, okay? It's very clear what what Congress have said to the FOMC, okay? And in fact, I was thinking of a completely exaggerated example, like, Congress has not said to the FOMC, hey, go and make sure there's 10,000 ice creams in the economy. Or I'm just talking random stuff, because what I'm saying is it's so clear what their job is. Their boss, Congress, has told them, you need to make sure there's maximum employment and inflation, price stability, right? That's what we're asking you to do. Just make sure if the American people want a job, they can get one, maximum employment. Make sure there's price stability, so things don't get out of control, and obviously economic growth, I guess, goes hand in hand with that. So I know what they're thinking, right? As soon as this changes, to be able to do their job, they're going to have to pull the interest rate lever, right? As soon as that changes, you're going to have to pull the interest rate lever. They're not going to tell me, and I don't know, and they probably don't know themselves how much they're going to do and what they're going to do. But I can certainly start to guess what they may likely do by looking at what? Hey, they're not the only ones that have access to employment data. Can you see how this is all now nicely coming together for us? I explained employment to you, and I told you why it's so important for traders who look at it early in the month. Hopefully now you can see why it's worth me spending all of these hours finally coming together, hopefully. See that? Payrolls. Why do you think the market has so much focus on payrolls? Because what they're realizing is, hey, if payrolls is a problem, can you see that? Starts to affect the mandate that the Fed have been given by Congress to achieve maximum employment. If payrolls is poor, the FOMC members can't do the job. They're going to have to make some changes. Their boss, right, that they got to report to, and I haven't talked about it, and I probably won't get into it, but the FOMC obviously does have to, I think it's twice a year they have to report to Congress, and I think you must have heard of it, right? The chairman gives a testimony, which people like to pick apart and so on and so forth to see if there's any clues in that as well. But ultimately, part of that testimony is saying we've been doing our job, and here's the proof: employment is this, inflation is, target, or it isn't, but we're going to make sure it is, and so on and so forth. Can you see why the communication is so important? And that's what traders are doing. They're looking to see what are the comments on employment. What can I see in the market, which comes before the FOMC statement is released, this communication. So let's take it a step back actually. When is that statement? What happens? I've said it to you guys before, you've got it on your calendar. Okay, so what happens is they have a 2-day meeting. Okay, you've got it on your calendar. The FOMC will get together. It's an opportunity for the 12 members to meet, to have a look at economic data. They're going to be looking at the same stuff as us. Okay, they're going to be looking at survey data, like the ISM. They're going to be looking at obviously inflation data, employment data, the same stuff that we do, and then they're going to make a decision. Okay, so why on earth, if they're looking at employment and inflation, would I not be looking at employment and inflation as well to try and second guess what their decision is? Number one. Number two, they will then, after those 2 days, that's why, do you see, the market will move a lot ahead of FOMC when payrolls comes out, because the market's trying to second guess what the Fed might be thinking. Hopefully you can see this all links nicely together. And then finally, this communication, okay, so important. It's an opportunity for the Fed to explain to the market what their thinking is. Because the last thing the Fed want, right, is the markets, say the stock market or whatever market is going up. Behind the scenes, the Fed is thinking, oh my God, employment is, getting out of control, and inflation is getting out of control. We need to hike interest rates. They just keep their mouth shut. This is what they're thinking. The market doesn't realize that they're concerned. They're thinking this. They don't communicate that to the market. And then one day they just come out of a meeting, this meeting, right, one of these meetings, and they just suddenly say, right, we're going to hike interest rates 50 basis points. It's going to cause chaos in the market. Okay, it's going to cause volatility, complete chaos in the market. The Fed do not want that. Okay, they obviously want to communicate that. So what they will do, maybe for 3 or 4 months, they'll put out some statements saying, you know what, we're a little bit concerned about inflation. It's creeping up. You know, we're a little bit uncomfortable. You see, they're hinting towards the market, so the market knows, oh, okay, the Fed is concerned. I should also trade or take a view on the market accordingly. Okay, I should also trade accordingly. Now, these are the things that you will become very good at once you start reading some of these statements, which we're going to do together. But it is a tool, you know, and it's very misunderstood. This is very poorly understood, that the Fed is using this as a policy tool. Communication, just simply communicating. Because think about it, you know, it's very important that communication is clear, so that people have some sort of confidence in what the Fed is doing. Because if they communicate things clearly, there's going to be an element of trust there, right? If the Fed says, look, all right, inflation is high, but as is the case right now, but don't worry, we're on top of things. See, the market's going to take confidence in that, especially during times of turmoil. So, you know, for example, where we had the COVID situation and, you know, market started tumbling, obviously the communication as a tool helps as well. So they can lower interest rates, yes, but they can also communicate to the market and say, you know, we're aware of things. We know things are really bad. Don't worry, we're doing everything we can. And you see, the market takes comfort in that, and that's why we had the big turnaround, even though interest rates obviously did collapse and help that. Why does it continue? Because the market has confidence that the Fed will continue to support it for months into the future. How do they know that? Communication. Can you see how the Fed can actually support the market just through words, just by talking and saying, hey, you know, don't worry about this. We got this. You know, we're happy to keep expanding our balance sheet. Right? They don't have to rely on the market waiting for them to do it anymore. There's trust. I'm just looking for the balance sheet expansion. Don't seem to be able to find it. What do I do with it? Got so many of these things open. Just bear with me. Sorry about this. Just give me 1 second. There we go. Okay, so that's the balance sheet. You know. So, you know, obviously the Fed would have communicated this throughout 2020, that we are comfortable to keep expanding our balance sheet, and then, you know, the market won't wait for them to expand the balance sheet. They'll pump up prices and asset values will go up because everyone has confidence, and not only confidence, but they've communicated it, right? So they're not going to wait for the Fed to do it, right? They will just start doing it. You saw that, you know what, and in fact, when you watch this, it may not be, but recently the Fed has been communicating to the market that it is going to start raising interest rates again, and the market has already started to sell off, right? Because obviously interest rates go up, GDP goes down, and obviously that's negative generally for the stock market. The market's been selling off. It hasn't even waited for the Fed to lower rates. But in a way that's good, because then you don't have knee-jerk reactions. The market has been forewarned. So this communication is almost more important, in my opinion, on occasion, than the actual rates themselves. Obviously, it's important to then follow up. You know, if you tell the market we're going to do something, you then better do it, because otherwise that trust is broken. People won't listen to your statements as much or take as much. You know, they won't take them at face value in the future. So obviously you need to follow up with that. But the point is that it's almost as important, if not more important, because the market will react more to the statement sometimes than the actual change. In fact, that's how it's been recently, because the Fed is doing such a good job of communicating what their intentions are, that the market knows, all right, let's just react to something that they've told us they're going to be doing at the next meeting or 2 or 3. Make sense? So that's why the statement is so important. Okay, and the reason I'm telling you all of this is because when you come to understand the statement, the things you need to look for is you need to think like a Federal Reserve person or an FOMC member, right? What is their job? Think about it. If you go to work every day and your boss tells you this is your job, you're going to do it, right? If they're their boss has told them, Congress, you make sure you keep employment as near maximum as is physically possible. Obviously, you're never going to get a 0% unemployment rate, but we talked about that before. Around 4% is pretty much maximum. And you make sure that inflation doesn't get out of control, okay? And basically promote economic growth, right? So we know what they're thinking. So we can start to look into the statement, and if we see that they're concerned about the jobs market, if they're concerned about the inflation rate, then we can try and second guess what they might do to interest rates, okay? And that's what traders are doing all the time. So look, great job. I know it's been long, and for me as well. It's been a complete and utter exhaustive exercise, but really, really enjoyable as well for me to. So I appreciate you letting me do this, and I know it's been a long, but hopefully you got a lot out of it. It's great for me as well to revisit some of this stuff. But what we're going to do now is we're going to go and you're going to see why I kept banging on about this employment and inflation and those two mandates that they have, because it's mentioned in the statement. Okay, so that's why it's important that I mentioned it. So what I want to do is I just want to go over to this statement. So we already know now they've got these tools at their disposal, right? With the balance sheet, the federal funds rate. Okay, just remember this, and honestly, you'll be so far ahead of anyone. Federal funds target rate, which is the short end of the borrowing curve. The long end is the balance sheet, which I've showed you many, many times, which is that, right? Which is kind of the purchases of, recently it's been, I think 80 billion treasuries and 40 billion mortgage-backed securities, but they've been reducing those recently. So they are trying to, they're still expanding the balance sheet, but at a slower rate. And recently they've been talking about bringing some of this down, okay, actually reducing it, which means obviously they can't purchase anymore. They're going to have to start selling some of these reserves. But again, they don't want to just shock the market and do that. They will communicate that, hopefully, when they do that. Remember those two things. So you need to remember the tools at their disposal, the mandate, what their boss, Congress, has told them to do, which is maximum employment and 2% inflation, and then you're good to go, right? You'll have a very good idea of which way they're likely to be going towards more aggressive monetary policy, i.e. raising interest rates, dovish or soft or supportive monetary policy, i.e. lowering rates. That's how these guys are thinking. If you know that, you'll be able to read the statement much better than anyone.